Now let's bring in Doug. You just need to on the screen. There he is. Good morning.
Hi, James.
Thank you very much for doing this. Obviously, we're all keen to hear about Edinburgh Worldwide and what's going on. But as usual, I'm going to hand over to you and just let you talk through the final I was trying to achieve, and then we'll get to some questions afterwards.
Sure. Yeah. I think we set through some slides. So if you could just go to the first slide in the pack, I think it's number 2. Next one. Yeah, perfect. Yeah, maybe just a bit of a reminder for those listening to what we seek to do with EWIT, because we think EWIT's got a very special remit. So we offer investors, we think, a unique exposure to immature companies really best positioned to shape the future. So for us, it's all about hunting for these tomorrow's winners effectively. So at their core, these are companies that are solving problems. They are using technology, innovation to build things that are better, cheaper, faster, with the potential really to rewire their industries, often involving a bit of a twist around business model innovation as well. So if you look back at sort of past successes that we've had there, we were the original team in Bailey Gifford that bought Tesla. It was roughly a $2 billion business at the time. First Model S cars coming off the production line, and it peaked at, north of $1 trillion, I think. And then we moved on from that one. In our funds, we were the original investors in Dexcom, became the leading diabetes management tool for type 1 and type 2 diabetics. We were the team that led the original work on SpaceX that saw us invest in 2018, basically at a point when the reusable rockets were in their infancy. And I think I'm right in saying that SpaceX hadn't even launched a single Starlink satellite at that point. So maybe what I'm trying to illustrate there is, look, there's a couple of things that you need to understand here. We look for smaller companies when we do our idea generation, but we really want to own very large, very relevant, ultimately huge and successful businesses, but buy them when they're small. And the second thing, particularly in the case of SpaceX there, it's having the flexibility to invest across public and private markets. Really, that gives us the most unconstrained, pure opportunity set to go fishing for these ideas in. But in a stock market and an investing universe that is full of noise, that we think it's the long-term patterns that matter here. For us, that really is believing and understanding that it's innovation and technology acting as the most strongest compounding forces. They are the things that drive society forward, drive stock markets forward. And when you look a layer deeper, it's this repeated pattern of greatest sort of changes, the most profound innovations that come along. They invariably start small, tentative, unproven. There will be lots of people wanting to shout them down, but those that can kind of get escape velocity from that, the runway for them is huge. And I think people often have short memories here. So even when you go back into the midst and look at, the beginnings of Amazon and Nvidia and Google, you see that repeated pattern. And to do that flavor of investing well, you need to be long-term. That is an absolute prerequisite. You need to have a high tolerance of uncertainty. If you don't have both of those, you will never unlock these opportunities. And frankly, stock markets struggle with that. They struggle with that at the best of times. And the last few years for our style of investing has not been the best of times. And that, as painful as it's been, that probably is the crux of the inefficiency that we as growth investors seek to exploit. The companies that we look for tend to be active in areas of real long-term structural growth. That's really what we're trying to illustrate on this slide here. Areas of deep change where we think the returns will be substantial, and the returns will probably accrue mostly to early pioneers in those areas. So that could be in healthcare with new biomarkers to interrogate and diagnose disease, oncology, dementia, antimicrobial resistance. We've got companies trying to, be at the forefront of driving all of those. You could come to the rocket launch industry, which is seeing huge growth as rockets shift to be these rapidly reusable types. Just the costs of getting something now into orbit is fundamentally changing. And that is unlocking huge business opportunities. Low Earth orbit, geostationary satellites up in the higher orbits, the communications infrastructure. Clearly, we own SpaceX, which is, a unique and arguably dominant asset in that space. And as you think about space and all the infrastructure associated with that really for us, it probably will be the defining commercial and geopolitical area of importance over the coming decade and beyond. We have long-standing investments in drones, a business called Aero Environment, and that's really proven its capabilities in the Ukraine conflict, and many countries looking to access that. But frankly, use cases that extend well into law enforcement and beyond. And if you could just flip to the next slide quickly. And this is really trying to capture why we look lower down the market cap scale, because I'm sure your listeners are very familiar with the recent narrative around the Mag 7 big tech being dominant. And I think people sometimes forget, as you come down the market cap scale, opportunity for asymmetric returns really begins to balloon out. So what we're doing here, we're defining asymmetry by proxy. We're looking for companies that delivered a 5x return in any 5-year period, and we're analyzing that over a 20-year period in itself. And when you look at sort of classic small and mid cap, we proxied that with a market cap range here. You have a 50% higher chance of finding those businesses in that small and mid cap area versus large cap. It's even more striking when you extrapolate that just to the bigger universe. The shots on goal argument is compelling for smaller company investing. When you delve a bit deeper again and you look at the industries that matter here, it's healthcare, it's technology. You go more granular, it's biotech, it's software. These are the areas where we carry a conscious, deliberate skew, because that's where we think you can access the asymmetry. Next slide, please, and we'll show that in action. So this is the returns of every single holding that we've held in Edinburgh Worldwide since I took it on, I think back in 2014. So lots of bars, lots of stories, lots of good stories, lots of pain points. But we're really trying to illustrate that there is this wave on the left-hand side of us, we think, being good at idea generation. Now, there's been real headwinds against that for the last few years, a very suppressive effect actually across that whole spread of returns. But it really illustrates that key point that idea generation is dominates here. The drawdowns can be extreme, even in your most successful investments, and you have to just be comfortable with that and live through the pain of that. Next slide, and we can explore the private companies area in a little bit more detail. EWIT currently has about 27% invested in private companies. That gives us access to areas that frankly are not well represented in stock markets, or maybe where the company you really want to own is private and not listed. I've touched on SpaceX already. We can maybe leave any more on that to the questions. Our second biggest private company is a business called PsiQuantum, a fascinating, albeit early business. We think they are really at the forefront of making quantum computing scalable and commercially relevant in a time frame that we think could genuinely surprise others. When you look deeper, we have investments in a business billion to one, really pioneering, very high cost, high effective, but very low cost prenatal screening, just from a few mils of a mother's blood, leveraging that same technology into oncology. Astranis doing geostationary satellite, very relevant for commercial and military applications. Epic Games, the owner of the Fortnite franchise. There's a whole host of businesses that we think are very, very worthy for shareholders to get access to, and we provide that in a direct, very cost-effective way. Next slide, please, and we can sort of delve into the portfolio in a little bit more detail. So where are we pointing at the moment? So in the left-hand quadrant, the blue one, top left, we have sort of 25-30% of the fund in healthcare opportunities. Yes, look, the timeline's long here, but just the increased understanding of biology, giving rise to new technologies, new treatments, it is really beginning to shift patient outcomes here. Novel treatments that operate at the genetic level with companies like Beam Therapeutics and now Mylan, companies decoding biology, businesses like Oxford Nanopore. There's a real DNA theme actually that we think is very prominent in the portfolio. The yellow section at the bottom, digital infrastructure. So think of this as new tools based around efficiency or marketplaces that are really basically allowing companies to apply analytics and AI and deliver great value for either their corporate customers or their users. Businesses like JFrog helping companies scale their software efforts. Appian, active in the low code area, just automating high complexity problems for their client base. And on the right hand side, the largest area for us, we define it in our own sort of terms here. We call it hardware 2.0. Think of that as companies that are at their core selling a product, but they are embedding very complex, very intricate either software capabilities or material science capabilities into that, transforming the hardware proposition and also often transforming the revenue model on the back of that. And that goes all the way from companies like Ceres Power, active in fuel cells. We have investments in solid state batteries. SpaceX, etc., clearly is in that area. Maybe one that's crept up the fund recently would be a business, Axon, provider of taser devices and body-worn cameras to law enforcement, and doing the archiving and all the analytics really on the back end of that. Next slide, please, just to sort of bring it all together. Look, clearly this has been a challenging period for EWIT shareholders. You can go into the sort of the back history of that, the rise in inflation, the interest rate spike. It was very difficult for growth investing and smaller company investing generally. It takes on, I think, an added complexity when you come to these early stage immature businesses. And frankly, we compounded that with some stock specific areas, and I do kind of get that. We appreciate how difficult that's been. I'm a significant shareholder myself, so I've lived that pain. But over the past year, with prompt and challenge from the board, we've sought to improve our processes, real tangible improvements, boosting the team composition, our decision making, discipline around the number of holdings we have, how we think about the financial resiliency of those holdings, and that is having a positive impact. So it feels like we're turning the corner, and I'd encourage your listeners to look at the 6-month numbers, and now indeed the 12-month numbers to the end of January. We really think we are moving out of this, and it's driven by the companies themselves. Portfolio feels primed. It feels primed for an exciting period. Our bigger companies are delivering, and we've got a host of companies that are really just about to hatch. Maybe just to conclude, I would say, hopefully, we've run through the spirit of EWIT, what we seek to offer. We genuinely think this is a unique proposition. Despite the challenges, look, I think shareholders would struggle to find similar exposure elsewhere, certainly at the fee structures that we offer. And with regard to some of the proposals that are facing shareholders, look, for us investing is pretty simple. It's providing capital and support to the founders, to the innovators, those with the audacity to want to shape the future. And we as shareholders can participate as they deliver upon that. It's not about chasing transient pricing anomalies. It's not about discounts to NAV. That's trading. It's a different realm. I get that, but it's trading. For long-term patient investors, it feels like allocations to what we do are fundamental. They're almost a necessity. It's emotionally appealing. It feels logical, but it is a kind of necessity. EWIT shareholders own part of that future. And I think for me, it'd be a travesty for them to have that taken away from them. Look, yeah, it's a big test of shareholder democracy and shareholder engagement coming up. I do get that. Yeah, don't let that be taken away from. Very happy to take questions on the philosophy, the portfolio, where people want to go.
Great. Thank you, Douglas. Yeah, so let's look at the big picture stuff first. There's a number of holdings. How do you decide what's the appropriate level of diversification in the fund?
In fairness, we probably let that get too high. So we're now about the sort of 70 stock level on the listed side. You can add a few more back in for the private company side. That feels more manageable. We always want to allow high potential idea that's got intrigue, a classic sort of marginal idea to be able to be owned. Now, where we've tried to sort of add a little bit more rigor and discipline around that is almost have greater competition for capital in the earlier stage ideas. So yes, we've shifted our number of ideas down, but probably the bigger change, frankly, is more competition for capital in these earlier businesses. We sort of ring-fenced 15% of the listed portion of the fund on our own, admittedly self-defined basis as being active in these earlier stage businesses. Businesses either not yet gross profit positive or gross profit positive, but not yet cash flow positive, earnings positive, etc.
The other end of the scale, 6 is 12.2% of the fund there. How big would you let that or another holding that did well?
We've generally got agreement that we don't like to run positions past 10%. Now that's easy in the listed sphere because you can actively sell these things, at a time that you're choosing. SpaceX is an unusual one because it's sort of, it's kind of, for us, it's crept up the portfolio very quickly, as has PsiQuantum. They've excelled operationally and fundamentally at a time when stock markets have had a difficult challenge. They've kind of moved and promoted themselves up the fund. I'm very proud to have SpaceX at that sort of weighting. There isn't an asset like it. Periodically, it seems to have keen to provide elements of liquidity, but again, it's primarily, I think you have to view that as a private company with patchy liquidity.
And then when you buy things, you're obviously looking for small companies. You explain why. What's the sort of smallest company you'd look at?
Generally, I would say for us, we don't get sort of sucked into that classic micro cap area of things. Now, I think maybe the thing you got to step back slightly and say, we look globally for these ideas. And when people talk about small and mid cap and large cap in a UK context, that is radically different in a US context. For us, practically, we probably don't look at too many businesses below $300 million market cap. Most of the ideas that we would generate would be in the sort of $500 million up to about $3 billion size. In conventional sort of terminology, that is classic small to maybe lower end of mid cap. It's a really deep hunting ground, and No, I used to run a UK small cap fund. My universe there was probably about 300 businesses, sort of FTSE 250 plus a few more. It's very, very hard to define our universe now, but we're probably something around 30,000 businesses. It's the deepest pond to go fishing for ideas in.
I mean, so you've now got 2 co-managers. So, but how big a team have you got, analysts looking for these ideas and presenting for you?
Sure. A team of 6 dedicated to working on this strategy. We have grown links into the private companies team at Baillie Gifford. I'm a little bit out of touch with exactly how many people are on that, but I think we're at least 8 at the moment. It may be the bit that as Baillie Gifford we possibly undersell ourselves on is there's 100 plus investors on our floor here. Most of us have probably only worked at Baillie Gifford. We get a few externals, but most of us came through the graduate recruitment teams here. We've worked on multiple investment teams. There's a real collegiate network. When we set our team up, it was basically done with a dual remit, which was to run portfolios and incubate these ideas, but disseminate them across the investment floor. So yeah, there's that untold story of that there's a huge network of engaged Baillie Gifford investors who love to hear about interesting high potential ideas. And when they find one that we don't know about, they'll bring that to us. You can have your direct team and you can have your tentacles, but the tentacles are part of a bigger thing.
There's an inevitable Trump question. I mean, obviously things have changed a bit in the US, and the US is quite a big chunk of your portfolio. Do you think it's generally positive, or are there areas that you're worried?
No, I would say we were conscious about our ideas shape how the fund looks. We don't set out on a sort of top-down agenda. The fund must look like this. Let's go and make it that way. The ideas that we were coming up with were increasingly aligned with some of these geopolitical tension points that had been bubbling up. Now, that clearly has relevance in terms of SpaceX and activities in space. The kind of crossover towards national security and military applications there is huge. I mentioned AeroVironment earlier on. We own a business called MP Materials, which is a mining business. Go back a few years, I would never have thought that we would own a mining business, but they are mining rare earth from a very high yielding mine in California. Basically the highest grade ore, these particular rare earths that are used to make very high performing magnets. You may say, Douglas, magnets don't sound very exciting. Any time that you want to convert energy from either electricity into kinetic motion, vice versa, magnets do that. Your iPhone is full of magnets. Or think of all the inductive charging that people use. That is a huge area of geopolitical sensitivity that the Chinese sit on the vast bulk of rare earths and of introduced export clamps around them. So as much as like America's tried to position chips as the technologies of tension, China has fought back in other ways. And we've been in tune with this for some time. So there's a whole swathe of companies that we own that are tapped into. And again, I'm conscious is not always the most positive thing to talk about. But there is geopolitical tension, and that feels like it's going to be around for a bit. But you can find technologies that are really on the cusp of relevance for that. Yeah, so that's been a real area. But in fairness, that was present in the Biden regime. My hunch would be the relevance of those things does go up in a Trump regime, and some of these geopolitical tension points that we see, that they're much less about ideology. In fact, that feels like almost very low down on the mix of things that matter. It is basically a battle for technology, and that will define who either retains superpower ownership or becomes the next superpower. There's maybe some of the stuff that's Trump's doing in a domestic sense, which gets lots of headlines. But when we invest in US businesses, we invest in them typically because they've got global relevance. No, but he's gonna go hard to try and improve the US economy. I think we do get that. He likes the populist vote. He wants to deliver popular policies and mandates. He wants to make people wealthy.
Yeah. He wants to stop marketing go up. Now we sort of do some sector stuff. So let's do biotech first, because this question here, would you accept this? Is it saying around 60% of the fund is probably health related? Do you think that's true?
No, that's not true. You think about classic biotech, sort of drug discovery biotech, we're in the 15 to 20% range. We have about another 15 to 20%, which can be medically related, anything from diagnostics through to businesses like Doximity, which is almost, think of that as a LinkedIn for doctors. So yeah, the healthcare exposure has come down. The frameworks, frankly, that we've put in place have forced it to come down a bit. And we've narrowed down, I would say, on the companies that we think are actually very heavily de-risked. If you look at the fund there, the second biggest position is a company called Alnylam. Now, we owned Alnylam when it was a totally unproven early stage biotech, first drug going into phase 1. It was long on promise and potential, really very little clinically that you could pin your hat on, but we could see deep intrigue around what they could achieve preclinically, and if they solved all the delivery and all the therapeutic challenges, just where this could get to. For those that don't know, Alnylam has a technology for stopping the production of messenger RNA from a gene. Basically stops a gene making its protein, and it can do that with pinpoint precision. You can point this at any gene basically in the genome, and they've proved that capability up in a host of rare diseases where it's known that one gene goes wrong. If we be clamped down on that gene, we can fix that disease. Got some very interesting trials in hemophilia, looking to extend that. It's made some great strides in forms of cardiovascular disease. But this is a business now, almost view the platform and the capabilities here are proven, and they're now beginning to point this at some huge areas of clinical relevance. So when we own these high potential biotechs, if they get it right, this isn't like, oh, we've managed to solve one drug, aren't we clever, and we're going to pop in the share price. These can transform massive areas of relevance. So the one particularly for me, I'm watching very closely with them, is they're doing trials now with Alzheimer's, and some very interesting theories that they've got around clamping down the production of the amyloid precursor protein, stopping you making all the amyloid products that give rise to Alzheimer's. So yeah, we're proud of the healthcare businesses that we have, but it's quite different from we're a 10-pot biotech. Can we have $300 million to see if we've got something work?
Fair enough. Within all of that, did you look at the whole obesity stuff? Have you got any exposure to that? There was questions here about Novo Nordisk, but I'm guessing that was too big a company to get involved with. Or so simply like
a handful of smaller businesses active at developing sort of follow-on compounds. We don't own any per se. I know Alnylam have activities in that area, looking at obesity in general, cardiovascular health. The GLP-1 area at the moment is sort of dominated by the two companies at the top of that. It's been quite faddish in healthcare. Go back a few years, no one would have given that area much hope, much thought, much potential. Personally, I would actually think that Alnylam could come up with some very interesting therapies in that area. You're seeing some of these, the Novos, etc., try and push their franchise quite far into areas that are almost nothing related to diabetes and obesity. But if you fix that, you might have secondary effects in other disease types.
And if we sort of switch sectors, AI is obviously a massive thing. So can you talk a bit about DeepSeek and whether you think that's made a difference to the whole sector, whether it affects anything that you hold?
Yeah, so you've had this, almost the narrative in stock markets over the past sort of 18 months or so has been AI heavy. It's all about data centers. It's all about pushing GPU power and building these local language models. It depends who you speak to, but they cost anywhere from 500 million up to a few billion. Don't get me wrong, those are big numbers, but there's lots of companies, frankly, that can afford to build their own local language models. So that always felt like something where, to an extent, that was going to be generally a bit commoditized. So you had NVIDIA almost at the top of the tree. Everyone needs the processing power, a commoditized layer of local language models that lots of players could be active in. For us, we've been much more intrigued about the applications layer. I'll come back and reference that, but just to quickly round out on the DeepSeek point, I've tried to read some of the papers on this. They're probably complicated, but I get the gist of what they've tried to do. It's stripping it back to build condensed, distilled down local language models where you don't sacrifice the quality and where potentially you don't have to use anything like the GPU compute. Now that becomes hugely relevant when you think about where you might want to deploy local language, and you can start putting it on devices like this. So maybe the model to date had been, okay, all that stuff has to sit in the cloud. If anyone wants to access it, it has to be in the cloud. Now you may find you get proper distributed edge AI, is the term that people use. And I always kind of thought that that's relevant, but this might be the huge unlock there. So that could be, the company that we own that could be hugely relevant for would be Raspberry Pi. A recent purchase for us, put close to home, a London listed business. Great to see sort of interesting technology companies come through London. And for those that don't know Raspberry Pi, they make these small single board compute modules typically used by hobbyists. And you may think that that's a bit niche. Why do you want to sell cheap computers to hobbyists? Those same hobbyists tend to end up working in industry. And there's been this repeated pattern of, in their day job, they're actually starting to deploy these things in significant volumes in real world applications. And these devices are cheap and the processing power is very strong. They have basically credibility to do edge processing and edge AI. So you think about everything that could be unlocked by things like DeepSeek. For me, it has relevance in businesses like that. But just very quickly to round up where we think AI will be most relevant. And this basically mirrors everything you saw with sort of 2000, 2001. All the hype that back then was about infrastructure. It was the Cisco's and Dell's, etc. And the next 20 years was defined by the companies that built things on that infrastructure. This applications layer matters. And the one for us that's almost at the pinnacle of that would be Axon, which I mentioned earlier. So they have recently launched capabilities to empower police officers that wear the body-worn cameras. And pretty much every time you see incident footage, it'll say Axon in the corner of it. They largely the monopoly type provider to that market. But a police officer now can return from being out in the field. He may have interviewed various people. He's attended various incidents. Historically, that would be hours for him to write it up. Now he just presses a button. Audio file gets processed and an auto incident report is generated, which he still then has to verify, but it takes seconds, not hours. The labor savings of these things, you're now really starting to see that. That's for us, that's where we can get in there and find these interesting businesses. I think we find a lot more.
Great. Okay. Thank you. Kind of going back to the big picture slightly, can you talk about where you think valuations are now and how that compares to the growth rates of the portfolio and how that might evolve over time?
Yeah, no, there's real divergences in value. So if you look at like the US market, either on an absolute basis or these sort of cyclically adjusted basis that people tend to work to, it's pretty up there in terms of historical numbers. Yet you can come to the opposite end of the spectrum, do this in the US or do it globally. And you look at the valuation divergence and performance, frankly, of large cap versus small cap. And, it depends where you go, but you're typically a 30 to 40% discount placed on the smaller companies area. That's frankly where we're active. There's been this very well documented sort of rise of the big tech that's almost dominated some of these valuation arguments. The concentration in some of these indices is huge. It's basically a few stocks that can control the earnings and PE narrative. Now, we don't struggle to find businesses that we think are hugely relevant, attractively valued. You can come to some parts of the world, particularly like the UK, where you can find great growth assets, screaming valuations. It's a bit more nuanced in the US. I kind of get that. There's always, there's some of these bigger picture themes at play, but some of it can get quite local quite quickly.
Then do valuations, is that the principal driver of whether you use gearing?
No, I'd encourage your listeners to think of gearing as almost pretty much a structural feature of the trust. It can move up and down with the pace of ideas, but we're not kind of sat there thinking, stock markets look a bit cheap for the next 3 months, let's layer on a bit more gearing. It's a differentiator versus vehicles, as are the private companies. So I would view it as something that in the long run acts to shareholders' benefit.
So if we come back to performance, obviously the fund had an amazing run around COVID and then has given that back up again, and it's giving it back up again is driven this picture of poor returns, really. But what we're seeing is kind of like an investment cycle. So there's a absolute question here. So there's a gentleman who says he's 72 years old. Clearly, EWI is a long-term investment. What's the kind of time frame that you think you need to look at this fund on?
No, I get that. Think of this as a strategy that is about backing people building businesses. Now, people building businesses don't think in terms of months, quarters, be cognizant of years, but frankly, they're probably thinking minimum periods of 5 years, likely thinking decades, and some of them thinking, what am I leaving here over a multi-decade period? So I think, flex that accordingly, but minimum 5. When we're engaging with these businesses, we're thinking 5 to 10 plus. If you look at our holding analysis, the average time we hold a business has been about 8 to 9 years. Now, again, like the data set's not not huge in terms of that because we set this strategy up in 2014. You have to have a time horizon that's consistent with how businesses are being built. That for us feels
obviously the Saba took advantage of the sell-off and the widening discount. A couple of questions. So first, do you think there's anything you could have done differently to change the performance? And secondly, do you think there's anything that you would do differently as a consequence of what's happened?
I think you have to understand that a portfolio like this, it's a spectrum of maturities. So we typically put things in towards the earlier stage, but we own them as they grow and as they thrive. So it is almost this spectrum of all the way from early to middle to executing at scale. And that's a path. Now, I'd say around the edges, there's the ability to sort of flex how that path looks. But frankly, it's difficult to have a remit like we do and sort of go for, the next 2 years might be a difficult interest rate environment. So we're going to not invest in early stage high potential businesses, but we're a strategy that invests in early stage high potential businesses. But there's a bit of flex. Maybe I would say the bit where we've made a lot of progress would be thinking about, well, what is an appropriate allocation to these businesses? If you want to incubate these businesses through times that may be good and may be bad, what's your capital discipline for how much you might want to ring fence in the earliest stage? That's where arguably we were light on that before. We'd always do it on an individual stock level, whereas now we've got much tighter rules around at a portfolio sense, how much will we have in the earliest bucket. And frankly, that's where you take a lot of the pain and in difficult times. It's reflected upon it. It's not, the interest rates didn't rise to levels that were high by any historical standards. It was just the pace at which they came through at. And it was investors around the world having to recalibrate to that. And as they did that, the time horizons just contracted. People's willingness to project out just evaporated. And a strategy like this is about the willingness to project out. That's the inefficiency that we seek to exploit. The last 2-3 years, we've been on the wrong side of that. My hunch would be the next 2 to 3 years will be on the right side of that.
Questions pops up here. You're talking about backing people. So what happens if the people change? It's within the business. Is that a reason to rethink the investment?
It moves around a bit, but the rough sort of steer, I would say, for our company is probably about half of them have the founder involved in some capacity. If the founder moves on, then I think often there is a critical sort of, well, actually, we need to have a serious look at that because, what are the reasons for them moving on? And don't get me wrong, it can be valid, but you need to understand that the people coming in are aligned with you and the reasons why you were thinking you were aligned with that business. People, so sometimes businesses need a change. They can need a change, and that can be a good catalyst to re-engage with a company. I don't think of these businesses as growing in nice linear fashions. It's not like the earnings growth of the index is 7%, and I'll try to find companies that grow perfectly around that. It can be wild oscillations and businesses that can make stepwise progress. Think about the skills of the people involved. Can they deliver upon it? Do they have the right alignment? Do they have the right time frame? And that can be a founder, it cannot be, but they're the key things that you're looking for.
Thank you. I think we're sort of running up. Let's just deal with the question, the perennial question here. It's just like to the extent to which you are invested in the trust. Is this your sort of main investment?
Like north of 1 million shares in EWE. It's a substantial amount of my personal investment wealth.
Yeah. Exactly. As you said earlier on, you shared the pain. Good. I mean, I'm a shareholder too. I don't think that there's any. I just cannot get my head around why people want to sell a portfolio like this after it's done really badly and is starting to come good. Just swap it into a portfolio of investment companies hoping to make 5% here, 10% here. I'm just getting there. I just. That fundamentally is the question that we're being asked to.
They're chalk and cheese in terms of their approach versus us. Look, I get that the world of finance and investment is a broad sphere. It totally is. But we're at one end genuinely as long-term investors trying to do the things that we think matter to long-term returns. And shareholders have been asked to flip into an arbitrage strategy, discount closure. A trading strategy, arguably a trading strategy masquerading as an investment strategy. Yeah, I share your observations.
Thank you very much for your time this morning, Douglas. Really interesting. Good luck with the vote. And assuming we all here in a year's time, we'll see you then, there or thereabouts. But
Thank you.
good
And
on
I just sort of one last thing I would implore shareholders to vote. It's very important, and it's a real test of that democratic process.
Brilliant. Thank you.
Thank you. Thanks for your time.
So we will be back next week, and Andrew Mahassey will be here doing the sort of roundup of January, which has obviously been quite eventful. And I'll be talking to Mark Boggett from Seraphim Space, who's another exciting growth fund, and we'll see what he has to say about the whole situation. So have a good week, and I will see you next Friday.